especially live on YouTube for the Tuesday edition of the Not Your Average Investor Show. I'm your host, Pablo Gonzalez. With me, as always, the man that I like to call GC because of his genius concepts that he's bringing forth today, for example, because he knows how to generate cash flow, because he's a great co-host, and because his name is Gregg Cohen. Say hello, Greg.
Thank you. I need direction here. Hello, everybody. Great to be with you.
And with us in the house are phenomenal community manager, making sure you got anything that you need, bringing us the moments that matters. That's why we call her MTM, and also because her name is Madison the Magnificent. Say hello, Madison.
Hello, everybody.
And we like to talk about how you might be watching this thing live on YouTube, you might be listening to it on the podcast, which has had a bump in the recent months these days.
No, appreciate all you podcast listeners.
Yeah, we're getting close to we're getting somewhere between like 700 and 900 listeners a week, which is pretty awesome.
Mm-hmm.
That means that our community is sharing it out there. And you know what? If you're one of those 700 or 900, then what you want to do is go to nyais.com, because we do this live show on Tuesdays and Thursdays. And if you're on the live show on Tuesdays and Thursdays, you might want to check out the podcast. But the most important part is
the roll call,
baby. All right, here we go. We got Madison checking in saying, welcome to the show, everyone. We got Lee, MVP, Bishop, wishing everyone a good afternoon. We got Christopher Lee from Fernandina Beach checking back in. We got Leslie Wilson greeting us from Denver. We got Shannon Baker in the house saying, hello, everybody.
Shannon Baker, touchdown maker.
Touchdown maker. I like it. We got the better Gregory Stone, howdy from New Jersey in the house. We got the mountain man,
Bill Green
saying hello from the mountains of Colorado. We got the ringmaster,
Andrew Barnell.
Drew Barnell saying,
it's tough because I don't see the chat going on. You're hogging it over there. So you're putting me on the spot here.
It's because I got these old eyes, Greg. When you're my age, you're going to know.
Of yesteryear.
We've got one of our favorite community members.
Oh, yeah? You put me on the spot.
Aaron O'Neill. It's Aaron O'Neill stepping into the light, checking in on the chat. We love it. We got Jordy Jacobs in the house from LA. Jordy, good to have you back, making a habit out of it. I love that. We got our regular Rosalind Riley checking in. Good morning from Murrieta, California. We got Deanna Melchiona, the new name.
New name. Welcome to the party.
Party, Deanna or Diana. Let me know how I pronounce it in the chat here from New Jersey. We got a good Jersey contingency over there. We got Gary Riley, Rosalind and Gary.
The Riley contingency.
Of the Riley family, the second family up in Not Your Average Investor Show.
I love it.
Yeah, we love the Rileys up in here. We got Tony D in the house.
All right.
Anthony Dida checking in from southern Florida in Jupiter. We got the first family, the patriarch and the matriarch of the first family of the Not Your Average Investor Show, Ken and Caroline Moline. We salute you. We got Marilyn Carterman. She's from Homosassa, Florida.
That's the home of the manatees, brother.
This is the time of year. She tagged me on Facebook.
Yeah.
The manatees are in full effect in
Really?
Homosassa. If you want to go make a sea cow friend.
So you're not allowed to touch them.
Good. You're not allowed to touch them. You're right. But you can swim with them, and supposedly they're very friendly. Let's just spotlight everybody here. All right. Who else we got? We got Raj Bantu. Raj, we haven't seen you in a minute.
All right.
Yeah, Raj Bantu's back in the house. My ride-along partner from the IRL meetup,
Mm-hmm.
Raj Bantu.
Mm-hmm.
We got Jeff Bolton. Hi, y'all from wet California. Jeff, good to have you back in the house. Spells it the British way. Jeff.
It's very refined.
It's very refined.
Jeff,
Sir Jeff Bolton as well. We got David Blanner in the house saying good afternoon. Oh, who else we got? Man, this is a good one. We got Kathleen Lubin.
The new name?
New name. Welcome to the community.
Welcome
Kathleen.
to the party.
Good to have you. Pumped that you checked in. We got the fairy godmother of the Not Your Average Investor Show community in the house, Jen Filzen from beautiful Monterey, California, checking in. We got Stevie B in the house.
All right.
Good to have you back, Stevie B. That was a long one.
Quite a roll call, baby.
Love it.
Bigger and better every single time.
I love the roll call. I love getting new names in here. Love members of the community. As you know, this is a community-driven show. We appreciate the questions. We appreciate the interaction. We love that people make real friends inside of this Zoom chat. And because of that, we're going to host another live IRL event. Breaking news. GC, tell them what's up.
Yeah, baby. We're putting the plans in place right now. We're getting all the details finalized. But one thing we know for sure is that we have another community meetup, Not Your Average Investor Show, JWB community meetup happening on February 25th. And this is going to be an incredible opportunity. We haven't had one since June of last year.
It was July.
June. We've had a lot of smaller meetups around, which are super fun, but this is kind of one of the big ones of the year. I think we're going to do this, maybe once a year, twice a year. And we're going to invite all of you to come here to Jacksonville, get to meet everybody in the community here, get to meet my team at JWB. We're even talking about throwing out plans of actually going to take a little bit of a tour of JWB properties, investment properties, for some of you who are interested in investing, but might not have actually been to Jacksonville yet or seen a turnkey rental property. We're thinking about throwing that into the tour, as well as just an opportunity for you to see some of the growth of downtown Jacksonville and JWB's properties, specifically downtown, and relating this whole thing as to how you can make a better investment decision with your dollars, especially as you're heading into a recession. Rental properties are proven to be a much more consistent asset class to invest in, and doing it with a vertically integrated provider like JWB is the way to go. So this might be your first step if you're new. We would love to have you for the tour on February 25th. Save the date. And if you are a veteran of the community, we want you to be here. You want to be here. You get to meet all of your friends that show up each and every week on the show. So we're super excited. We'll have details coming out here pretty soon, as well as ways for you all to sign up and register. But yeah, February 25th.
Yeah. So we know Jenna Renee already bought the tickets. Tony D is checking in saying that he's coming. Shannon Baker said she had a great time in June. I hope that Lee comes this time around. He's asking, are we going to meet the JWB team? We always got the JWB team out there.
We do. So it's a Saturday this time.
It's a Saturday,
which is different. So we're putting all the logistics in place to make sure that for those who haven't had the opportunity to meet the team, maybe you haven't come on a client tour yet, this would be a great opportunity to meet the smiling faces of JWB.
Love it. Love it. Do you see someone like Shannon who came last year, said she had a great time? This time around, I know we're not ready to release a couple of experiences that we're planning, and we're going to make it a little bit different this time around, but kind of like seeing what's going on in downtown from June till today or February, right? Like, what can they expect? What's different?
Well, Shannon is on my team. So
touchdown maker.
She is also the touchdown maker.
Yeah.
She's also part of JWB.
Okay.
So she has been on the downtown tour. We actually took our team internally downtown not too long ago. So, but somebody who is new, like somebody else named Shannon, not necessarily Shannon Baker, the touchdown maker.
Mm-hmm.
Downtown Jacksonville is in the middle of a resurgence, right? I just wrote an article that was published on the Jacksonville Business Journal, and I outlined the 5 phases of a growing and revitalizing downtown. And Jacksonville somewhere in phase 3 and phase 4. And it is super exciting to see not just the projects that are getting approved, but when you get to phase 3 and phase 4, and you start to see projects that are in the ground or coming off the ground actually being completed, like some of JWB's projects have actually been completed since the last time we took this tour last June. You start to see restaurants taking shop, right? You start to see other developments that are starting and finishing. You see projects outside of JWB, and this whole thing that we have been talking about for years and years and years about how downtown is reaching a higher potential than it ever has in Jacksonville. It's not just theory anymore. You can walk the streets with us and see it. And the reason that this should matter to all of you is that if you can tie your investment dollars to a market that has a growth agent like a revitalizing downtown, your overall returns on investment from investing in single family rental properties around that downtown is going to be much higher. And so that's really how this whole thing comes together. That's one of the reasons we're going to dedicate some of the tour to showing you what's happening in downtown Jacksonville. And the coolest thing is if you came last time in June, you're going to be blown away. Specifically, one of JWB's first major downtown projects didn't look very good in June of last year. It's still a lot of work to do in June of last year. It's going to have its certificate of occupancy. We're going to actually open it up for you. It's going to have its certificate of occupancy in about a week. So it's going to be starting to be leased, all of this good stuff. You're going to actually be able to walk through and see not just the vision, but actually what's happening. So it's going to be a great opportunity.
I love it, man. When I think about the first one that we did, which was not June of last year, but kind of like December the prior year.
Mm-hmm.
And before that, it was like a month before that you and me took the downtown tour of like, what are we going to show people? It was like hard to get a bite to eat.
Right. Yeah.
You know?
Yeah.
Like, I think it's cool. I think it's cool that, you're going to start seeing this, like a well-to-do downtown with like eating options already and things like that. And that like the beautiful plaza and all these awesome things that have already been sprouting up.
Mm-hmm.
I'm excited for it. And, with the Jags in the playoffs, think it's only good stuff. Right?
What do you know?
What do you know?
Jacksonville's riding a hot streak right now.
Jacksonville's hot.
Dolphins are also in the playoffs. Congratulations, my friend.
Thanks, Greg. I
Dolphins.
accept your congratulations.
Knocked out the Steelers from the playoffs.
That's
yeah,
right.
I have some crow to eat.
Because we are NFL royalty, Greg. You know, we're the only team.
You and Skylar Thompson are NFL royalty.
That's ever had an undefeated season. I don't think that the Steelers
Never
would
heard that before.
Greg.
Never heard that.
So, you know, we belong there.
Let me count my fingers that can hold Super Bowl rings here.
Well, yeah. All right. So we teased the show. We had some other topics to go, but last Thursday you said Omaha, you called an audible on me. And you wanted to get into these 3 stats, right? Because we know that our community comes here for these insider statistics. So we figured that this would be a really, really good way to do it. First statistic that you threw out to me was home price affordability by market. Tell me more.
Well, you know, home price affordability is a very hot topic as home prices have increased over the last 2 years at a very high rate. And especially as interest rates have risen for the fastest growth of interest rates in the last 40 years, it's having a real challenge when it comes to home price affordability. And home price affordability affects demand for housing. And demand and supply ultimately affects where prices go, and prices, of course, affect your overall return on investment. So we need to understand affordability as it is. It is the number one threat to demand that we have in the real estate market here. And so, like we always do every single month, we're always in touch with John Burns and his consulting team, and we pay attention to the metrics they have because there's just such a wealth of knowledge beyond what we know here in Jacksonville. And as I was listening to their monthly call, I took down some notes that I thought were really just important to share with you all. So what John does is he puts together and has put together over the years what's called his Burns Affordability Index. And so what he does is he looks at the cost of housing and the income in different markets across the country, and then he rolls it up to the entire country. And so you get to start to see which markets are more affordable and which ones are less affordable. But not only do we have that information, he also tied it to the most recent other peak of housing in the mid 2000s. And so I thought this was really interesting as well, because if you start to see what housing is right now, compare it to the overall country, you can start to see which more affordable. But if you go to the last time that there was a big shakeup in the market, right? In the mid 2000s, right? Prices were high, and then the Great Recession came afterwards. You can also see which markets were more affordable at that point in time and which ones were less affordable. And so you start to learn insights, not just to affordability today, but how do those markets react back in the day as well, which might be interesting for us to know as far as how markets are going to perform from this point forward when it comes to affordability. So a lot that I gathered from listening to this call and thought we'd just kind of go through some of those stats.
That sounds super interesting, right? So we are essentially under the belief, as we all have, that things happen in cycles in the real estate market. And it's kind of like, you know, even though real estate generally always goes up, right? It's kind of like loops, right? So if we can contextualize the idea of where other markets were in context to affordability, that gives us the perspective to then be like, is this overheated? Is it not overheated? Right. And then what does the future look like for this cycle, part of the cycle that we're in right now?
Yep.
Very cool.
And part of this is, you know, some markets are always going to be less affordable, right? And there is a sort of let me try that again. There is a sort of historical index for your market, right?
Sort of historical index.
Sort of historical. There we go. Write that down. Yeah. So, you know, the markets in California, right? They're always going to be less affordable because they are more desirable because of weather and, you know, other things that make it more desirable. So there are always places that are more desirable and less desirable. And one objective way to see that is which ones are more expensive historically and which ones are less expensive historically. And if you are in a market right now, which is way more expensive than it normally is, one of two things is happening. Either it's way overvalued compared to historical standards, or it's much more desirable. And then people are now paying more to get there. And, you know, a lot of times the truth is somewhere in between. But it's at least cool for us to look and standardize what happened back in the day. Where are we today? And like all things when it comes to home prices, right? We're not looking at this in a vacuum. This is one data point to take into context. It's not going to tell the whole story, but it's a cool story to look at and at least kind of understand objectively, which is, the reason I wanted to bring it up to everybody.
Okay. Sounds good, man. So how do we do it, man? Do we throw up this chart?
I'll kind of talk through some numbers here because
Okay.
that chart kind of gets a little hairy there. We'll jump into it in just a second. But overall, so the housing cost to income affordability index for the entire country is 41%.
Okay.
So housing cost to income, 41% for the entire US.
That is how much of your income is spent on housing per market average.
Yeah.
Right. So like I take my salary to my monthly rent or mortgage expense and taxes, whatever, and divide that.
Yeah. And this would be if you bought the house. So it assumes a 6.6% interest rate, I think, which was at the time of this report was the average interest rate. And then it assumes, 20% down or something like that. So it comes up with a payment number based on that.
Yep.
And then whatever the median income is compared to that would be 41%.
Sweet. Okay.
Yep.
So on average, the US median, 41%.
41%.
Cool.
If you want to be in a more affordable market, you want that number to be lower.
Lower.
Right?
Correct.
So Jacksonville's is lower. One of the things that we have going for us, right? We have been known as an affordable market, even though we've seen significant home price appreciation. We still are affordable. So Jacksonville's Burns Affordability Index, which is that housing cost to income thing. I'm just going to call it the BAI or the Burns Affordability Index. It's at 35%.
Nice.
Yeah. So we are a more affordable market here in Jacksonville. We're rated as what's called average. So then they rate it as affordable, then average, then expensive, and then very expensive. And there's only two other markets. Burns tracks the major metros. So call it however many 50, 75 major metros out there. There's only two markets that are in the affordable section, right? Jacksonville is in the average section. So there's only two markets that are affordable because home prices have risen so much and because interest rates affect all housing prices that way. So we're in the average category. There's a whole lot more that are expensive and very expensive, but only two that are now in the affordable category.
Yeah. And to me, it makes kind of sense to thinking about it as, we hear about these like steadfast rules of your income, your housing expense should be somewhere around 35% of, you're right, like it's like in the 30s of your total income, right? So like the idea that we at 34% are average.
35%, but
35. I'm trying to look at the chart. I don't have the good eyes. So you'll find out when you're
geriatric over here.
So kind of, like right there, like right around 1/3 of your expenses. That's kind of like what we've all grown up with, understanding that. So, I look at this chart and it's saying that the average ones are in the 30s, the affordable ones are like in the high 20s, essentially. And then there's everybody else. Jacksonville is right in line with that. And then I also think about the idea of upside inside the market already, right? Like what are the other telltale things that are happening that mean that this, either there's more economic opportunity coming this way so that there is more jobs and median incomes are rising. And also like how many people are also moving here, which means that it's going to drive the price of the home up as well, right?
Right. Absolutely. All of these things, if your home prices go up, but you don't raise median incomes, then your affordability percentage goes like higher. It becomes worse, right? You can still have raising house prices. And if jobs come in and downtowns revitalize and your median incomes go up, well, that's what we want to be investing in as a real estate investor, because then prices can still go up, but you can still be affordable, right? That's kind of the goal here for why we put so much into Jacksonville and why we want everybody to win with Jacksonville's growth.
Cool. So should we show the chart and just kind of like kind of show through it?
So that's the first point, but then we can kind of get nuanced here.
Oh, okay. Okay. Let's get nuanced. Okay.
You had a really funny look on your face when I said nuanced. You got really excited.
How would you describe that look to our podcast listeners?
I don't know. Just do it again.
Oh.
That was pretty good.
Yeah.
So well, did you fire it up there?
I haven't fired it up.
We're teasing them so much with this chart.
I was too busy with my face.
So this is straight from John Burns, just to make sure credit is given where credit is due. And as you can see here, all of these different metros are rated into very expensive, average, and affordable. And Jacksonville is there in the average category. So 35% is our housing cost to income ratio. Now, here's the really interesting, nuanced part of this that I really picked up on. They also put a little diamond for where for where the housing cost to income ratio was in the mid 2000s peak.
Okay.
For each of these markets. And so the thought here is that if your mid 2000s peak was closer to where your housing cost to income ratio is right now, well, you're closer to that kind of historically kind of indicator of what your affordability should be for that market.
Interesting.
Right? If you are a market like Dallas, which has a current Burns affordability index of 42%, but back in the mid 2000s, it was like 28%. Well, that's a large spread. That means that in the mid 2000s, right before the real estate market took a dive, it was a 28% for affordability, right? Now it's 42%. That might open up a market like that to a bigger dive. Now, that also could mean that market is so much more desirable now that the real historical number should be closer to 42%. Can't look at this, and get the exact answer for what it will be. But this is a data point that most people are probably not thinking about.
Yeah, that makes a lot of sense, man. So when I look at this Diamondo over here, you see that Jacksonville's is pretty close to exactly where it is right now, right? Like out of all the average markets, it has the least amount of like shift between where the Diamondo is and where the top of the bar, where the top of the bar chart is, meaning that it has changed the least.
Yeah.
Right. So then kind of like what you're saying, you're not looking at this in a vacuum. You're looking at this and thinking, okay, so what are the other extemporary circumstances? What else is around this thing, right? So, not to mention for the podcast listeners, right, kind of at the top on the red line of, 70% plus is San Francisco and LA. At 69% are Orange County and Miami, San Jose, right? Like these like historically expensive markets that are built for movie stars and
desirable
and very desirable,
right?
Yeah. Very, very desirable places. The average expense there, that's nuts. People are spending almost, like more than 2/3 of their income on their housing. And then you go down the line and it's like San Diego, New York, and the East Bay. They're all still above high 50s. Going down there, and then you get to like Sacramento, Vegas, you get to the East Coast, you get to Orlando, which is now at a shocking 45%, but the Diamondo hasn't moved that much. Right. So but Orlando has been there. Vegas is at 42%, but it's moved upwards. Boston doesn't seem to have had a lot of change, right?
Right.
It's an expensive place, but that's where it is. And then there's the national average, and below it is the other Florida market, right? Tampa, that's at 41%. Diamondo has moved a lot. Austin, who has greatly changed. We all know this, right? Like Austin has kind of like just blown up.
Yep.
Big tech boom. Denver has blown up. Nashville has blown up, right? Like these are cities that we kind of compare Jacksonville to, right? That have these like other factors, right? Like the quality of life in Denver, and the tech industry in Austin and Denver particularly have really blossomed. I think Nashville has really grown up, and the creative industry has become much more of a business driver. And I think Instagram really helps Nashville a lot too.
Yeah.
Right. So number one, like bachelorette party destination and all these things. Right. And then you get down here.
What do some of those places have in common there? Like Denver, Nashville, Charlotte.
Property values have gone bananas.
Talk about downtowns though.
Oh, okay. Tell me more.
Yeah. Well, so this metric here is not saying that all of these are the same amount of overvalued or even overvalued in general. But if you start to see how that Diamondo has a big spread between what it was and what it is, that is some variation of desirability going way up and maybe some variation of being overvalued. But Nashville's downtown, huge success. That's what we really peg ourselves to in Jacksonville as being the next Nashville. I mean, it was like 23 or 24% in the mid 2000s was its affordability. And now it's up to 40%. Well, how much of that is sustainable? I don't know. Right. We're going to see how this plays out, but you can see how the growth of a downtown really assists.
Interesting. Charlotte too has moved greatly, right? We talk a lot about Charlotte. Charlotte is slightly above Jacksonville in cost in this ratio, still in the average range, but it's really, really moved. That's another place that we compare ourselves to that had a downtown come online.
Absolutely.
And then there's Jacksonville that hasn't really moved that much. It's still in the average. Downtown hasn't come online yet. So
Exactly.
plus all the, all the other data points, right?
Right.
Like the warm weather, the the affordability, all these different things, the very stable financial sector. Drew Barnhill saying here in the chat that a lot of these cities that are top heavy have heavy foreign investment. They don't have to rely as much on local incomes, right? Like
Sure.
Jacksonville is very much a local income.
Miami, LA, San Francisco, for sure.
Yeah, totally.
Absolutely.
Orange County, all that stuff.
But if you're looking for something that would, mitigate risks as we go into the market for 2023 and 2024, being in the average category as far as the housing cost to income ratio, a strong plus, right?
Yeah.
Not having a large spread between what the mid 2000s peak and what it is today, a strong plus, right? Those are all positive indicators for risk mitigation and, not having the sort of housing decline that we had in 2008.
Interesting, man. Interesting. So Bill Green, the mountain man, he says he lived both in Nashville and Denver in the 2000s, and they both had clean, active growth and living, right? Like, which very similar to here as well.
Absolutely.
Yeah. Very active, kind of like outdoorsy areas, people that like the outdoors, and very clean and growth.
Yep.
Right. Awesome. Interesting, GC. Good stuff. All right. So let's summarize this, right? How would you summarize this as let's say a TikTok reel?
Well, when you're thinking about what housing is going to do in 2023 and 2024, housing affordability is the number one driver of demand, or the number one threat to demand. And so if you want to mitigate risks, you need to invest in a market that is more and more affordable. And so when you look at affordability, Jacksonville is definitely on the affordable side, right? It's known as average here, which is affordable for the overall market. And then what you can also do is think about, well, what happened the last time that there was a peak in pricing? Was it so much more affordable then than it is now? And Jacksonville really stands out there as not having that large of a spread. So the historical kind of desirability of the marketplace is largely what it is in terms of housing price affordability today. So those are two really strong indicators that, the risks of a potential downfall of housing in Jacksonville is less than in other parts of the country.
Yeah, what I hear is like less risk of a bubble, which is the thing that we're all afraid of, and more kind of like permanent upside. It's not going to go anywhere, and it's going to continue to grow the way that it always has.
Absolutely.
Love that. Love that. All right, you see, good stuff. Lee Bishop's got a question here. How much of a fluctuation is it in the JWB 5 areas, in the JWB, like 5 neighborhoods that JWB invests in? Do you think that is there a difference between the areas that JWB has invested in versus the average, Jacksonville price point here?
No, I'm trying to see the point. And Lee always has really, really good points. So Lee, let me know if there's something else to that question. But, the neighborhoods that JWB invests in have been the same neighborhoods we've been investing since 2006. They are affordable neighborhoods in an already affordable market, which is what Jacksonville is. And so, no, I don't really see much fluctuation, right? Incomes and home prices have gone up across the board in Jacksonville. And so there's not a whole lot of difference between what we're seeing here on this slide or the concepts that we're drawing here versus JWB neighborhoods. They haven't become unaffordable neighborhoods in the Jacksonville marketplace or anything like that. They're still affordable, middle income to below middle income neighborhoods. That's where we want to be.
What about the statistics that you've talked about how like JWB neighborhoods have appreciated more than other neighborhoods? How does that play into this?
Yeah, well, so JWB neighborhoods have appreciated 79% more than other neighborhoods in Jacksonville since 2013.
Okay.
But, you can still be you can be below middle income. You can appreciate 79% more, and you can still be below middle income to middle income type neighborhoods.
True.
So yeah, that's where we focus. We want to be in neighborhoods that have low home prices compared to the median in Jacksonville. So I'll give you some stats there, right? The median home sales price in Jacksonville is about $350
It's about
right
350. I just saw it. Yeah.
Yeah. And, the typical JWB home that sells, you guys see it every single week on the property of the week. It's, 180 at the low side to maybe about 280 on the high side.
Yeah.
So that's below middle income.
Yeah.
Still. So yeah. So that's where you want to be. Low prices, high rent, surrounded by jobs. Same model still applies.
Same model, still kicking. All right, man. Well, that was point number one. Point number two that you wanted to stop the show for. It's a little trickier, right? Like you wanted to talk about builder inventory in Jacksonville that's about to hit this market.
Yeah.
Tell me more about that, GC.
Well, so for those who were on the Jacksonville real estate market update call, you guys asked a lot of questions. What are house prices going to do? And my answer was, guys, I don't know. I don't know if anybody really knows. And it was not because I lacked the data that I've used in the past to come strong with our predictions. It's just that the data is conflicting right now. You can look at demand and you can look at supply and you can draw your own conclusions. And I think it's largely dependent on what significant agents of change like the Fed do. That's going to dictate where pricing goes. So with all that being said, we just looked at one that would show that, housing is more risk mitigated in Jacksonville, right? You would expect it to keep its value or, even increase more than in other places in the country. Well, I'm going to give you some other information here that's just going to show, some of the opposites of viewpoint there, right? And I think it's really important for you all to see all of the data that I'm looking at here so that we all can draw our conclusions rather than just seeing just the rosy picture. So I wanted to share some of this with you all. One of the big things to take into account when thinking about where prices are going to go over the next 6 to 12 months is what supply is doing. And usually measuring supply is pretty easy for us. We look at this metric called months of inventory, and months of inventory tracks the number of homes that are available on the market. And then it tracks the number of home sales that happened the previous month. And it's a metric that has been used historically to guide where housing prices are going to go over the next 6 to 12 months. If that measurement is between 6 to 7, generally you're going to see normal home price appreciation in Jacksonville, which is
4.6%.
4.6% per year. That's back since 1982 on average. You see 4.6% appreciation per year. So we measure this every single month. We see if it's less than 6, that's an indication that you would see higher than 4.6% appreciation over the coming 12 months. And you guys have seen that our predictions have been pretty darn accurate. And this is one of the most important indicators that we use. Well, right now, MOI stands at 3.7.
Okay.
That is lower than 6. All things held constant, that would tell you that home prices are going to go up at a rate that's higher than 4.6% appreciation over the next 6 to 12 months. But au contraire, mon frère.
Au contraire, bonjour.
I did not predict that housing prices are going to go up more than 4.6% this year on the real estate market update. And here's part of the reason why it's hard to know. It's because even on the supply side, there has been so much what's called shadow inventory that has been about to hit the market, but we don't know how much is going to hit the market because there's a lot of building that's been going on. We don't know if that is all going to become for sale inventory or if it's going to become for rent inventory, because builders now are building to rent out communities, very similar to what JWB has been doing for over a decade now. Big builders are doing this now.
Can we stop and define shadow inventory? So so shadow inventory, if I'm hearing it correctly, it's housing inventory that's in the pipeline that you are not sure if it's going to be for sale or for rent?
It's shadow inventory that's in the pipeline that has not hit the market yet. And when you have a large amount of it, you don't know how much that's going to tip the scales for months of inventory, and then eventually it could affect pricing. So shadow inventory would be a large amount of properties that are about to hit the market. They're in some stage right before it actually comes on the market. And to make it a little bit more of a challenge this year, we didn't used to have to decide or understand if it was going to go to for sale housing or for rent housing. Now that's in the mix as well. So it makes it a little bit more challenging.
Got it. So the reason why it's challenging to predict is because, correct me if I'm just taking guesses here. When it's tabulated, you don't know what stage of construction it's in. So you don't know exactly when it's going to hit the market. And on top of that, you also don't know how much demand is going to change in the long and short run as well, right? So either way, one of those things could, depending on when it hits versus demand versus readiness. Yeah. You can't really know that for sure. And then on top of that, right now, there's also the extra wrinkle in this thing that is, you don't know if one is going to be for rent or for sale.
Right. And the reason why it's a little bit more difficult now, you always have some sort of shadow inventory. You always have construction projects that are in some stage that you don't know exactly when are going to hit the market. But what happened over the last 2 years, it was the biggest rush to grab land by builders. They bought up as much land as they could, and they started as many projects, as many builds as they could.
Yep.
And so, and then you got supply timeline challenges and things like that. So it's a little bit more complicated today than it has been in the past.
Got it. Drew Barnhill puts in the chat here, much of the builder inventory coming online is multifamily. Is that true, or is that also something that you don't know in the shadow?
Well, that is true as well. That is absolutely true. It's another wrinkle in there. Builders have been building apartment complexes because those have been some of the best asset classes to invest in over the past couple of years as rents have skyrocketed. So those markets are certainly a part of what's going on in the construction industry right now.
Okay, cool. So now we understand shadow inventory. Leslie Wilson is saying shadow inventory can also apply to individual homeowners who become unintentional landlords by renting out their primary residence. This often happens in a layoff situation where a homeowner loses their job and finds another one in another city and is underwater on their house, so they decide to rent instead of sell it.
Absolutely.
Okay, cool.
There you go.
Right.
You could see more of an impact on that, coming into 2023 as we expect to be in a recession as more job losses happen.
Yep.
So yeah,
shining a little light into the shadows.
You go.
This is not where Erin O'Neill resides. She is into the light.
She's into the light.
All right.
So and there's just no real data on this shadow inventory. That's why it's called shadow inventory. But we're really closely tuned in with the biggest builders here in Jacksonville. They're friends of ours. We talk a lot. And so I just wanted to share some of the conversations that we've been having. We're expecting about 2,000 to 3,000 homes to be hitting the Jacksonville market in the coming months. And these would be all of the homes that are being released by big builders for sale inventory. So it would show up in the inventory section of our months of inventory metric, right? So 2,000 to 3,000 sales hitting the market in a relatively short period of time can have a pretty big effect.
It's a big deal.
Right?
Yeah.
So, but again, not so easy. That might scare some of you. Now you're like, oh, geez, what's going to go on with the market? Well, let me give you a little bit more nuance here, right? Some of you are concerned about inventory levels jumping up and jumping up and jumping up. You'd be surprised to know that the last 2 months inventory levels in Jacksonville have actually decreased.
Oh, okay.
Au contraire, huh?
Au contraire.
Yeah. So we have 7,502 properties on the market here as of December 1st. In the previous 2 months, we had more than that. So you've got kind of that happening. But here's something else too. So I've been listening to a lot of the builders' earnings calls, and people have been asking the builders, as home sales slow down, are you going to basically like slow down your rate of sales with the market, or are you going to keep up a steady pace of sales and basically give incentives or price decreases to make that happen? Because if big builders give big price decreases, then that could soften the housing market, right? That could lead to a decline in prices. And the big builders have said, we are going to keep up a steady pace of sales. So that would be a threat to pricing, okay? But the way they're going to do it is through incentives.
Okay.
Which when you give incentives, you don't actually drop the price of the house. And so it's a way for them to sell more houses, but not actually drop the price of the house. So the other thing to keep in mind is that builder margins right now are at pretty much an all-time high. So they have room to give incentives. So they're trying to do this dance. Number one, they want to keep sales at a steady pace. They want to do it in a way that doesn't decrease prices, because that ultimately decreases their profitability going forward on the comps they would set, on the market comparables, other sold houses they would set. So it would kind of hurt their ability to sell in the future if they kept dropping prices. So not a real conclusion that I'm going to give you from this one, other than these are just important data points to know. And this 2,000 to 3,000 houses of shadow inventory coming down the pike in the coming months here in Jacksonville, good to take into account. Not necessarily, a sign that housing prices are going to go down, but just, again, you can't look at any of these things in a vacuum. It's contrarian to maybe housing prices going up. Looking at some of this data, just like, the affordability one was saying that we were in a better spot.
Yeah, when I think about like the purpose of the show is to educate our community to be able to like make their own decisions on things that are happening, right? Like, so now we are talking about this on the show. Nobody else is talking about the statistic in Jacksonville, right? So now, if months of inventory were to go up, a possible reason why. You can judge that based, you can then put that into your own, brain calculator and say, okay, I know that that's happening. So if I see another force that is going to like either increase demand or decrease that supply behind it, then I know I can make a better investment decision for myself kind of thing, right?
Yeah. And if you're thinking about rental property investing, short-term pricing is the least most important thing. So none of this should really affect your decision to invest in a rental property, because you're going to be holding on for, hopefully a full market cycle, at least 5 years, but hopefully for a full market cycle. But yeah, this is important to know. And then, what I like to do is to take these things, then run scenarios off of them. So let's say that 3,000 houses hit the market. Well, right now we have about 7,500 on the market. And we have 2,033 sales. We'll call that 2,000 in sales. If we added 3,000 houses to the market, is that going to tank the real estate market in Jacksonville? No, because we know historically MOI between 6 to 7 will get us to an average and normal performing market.
Got it. What's that number? Did you do that calculation of like, if you add those?
Yeah, it's roughly 5 months of inventory.
Okay. So still under the historical average.
Exactly. It'd be 5.5 months of inventory is what it would be.
Got it.
So good to take into account. Hopefully, as I'm reporting more of the months of inventory numbers in future months here, you'll see this. You'll be prepared. You'll know it was going to happen because you tuned into the show. But yeah, just another indicator here.
Got it. So basically, if I was to summarize this thing, there's been this ongoing shadow inventory in Jacksonville of builder inventory, right? Shadow inventory being homes that are in the pipeline to be built, or residences that are in the pipeline to be built that you're not sure exactly when they're going to come online. There's a new wrinkle, and that's that right now builders aren't very clear, and you're not able to prognosticate whether or not it's going to be for rent or for sale. And if you were to take this shadow inventory of about 2,000 units that could go in one way or the other, and you multiply that and you put that into the months of inventory equation, which is what we use to predict short-term housing, it may give a temporary kind of like rise to short-term housing, but builders are not going to drop prices because right now they have margins, and their plan is to give incentives and still keep the pricing where it is to keep it going. But even if they were to do it and all of these units were to hit at the same time and they were open to dropping pricing, historically speaking, we are still at below average historical months of inventory, and therefore should predict a regular rate of appreciation for Jacksonville, which is 4.6%.
I would everything you said there is accurate, but I don't think you really can draw any conclusions on it right now, because I could easily paint a picture of how this one stat could lead to a higher than normal increase in appreciation over the next year. And I could also position this as leading to prices declining next year. There's just too many things. That's why when we did the real estate market update, there's just too many big variables here. This is a small data point giving some light into this shadow inventory. We have to see how it's going to play out though, right? At the end of the day, historically, when you're between 6 to 7 months of inventory, prices usually go up. But nothing is normal about this market right now, because the Fed has raised interest rates for the fastest rise of interest rates in 40 years. So you could have lower than normal MOI, lower than normal months of inventory, and still see housing prices come down because the Fed might jack rates up even higher. So contrarily, on the contrary, you could have 7 months of inventory and the Fed eases off interest rates and you could have housing prices go up. So, it's too new. We just need to be paying attention to the metrics here, to the indicators, and we're going to see how this plays out in the coming months.
So if I'm thinking as a not average investor, I'm not going to try and time the market. I'm just going to look around, and if I have money that I want to invest, because you have to be investing your capital, and if it's just sitting in your bank account, you're losing to inflation, and you're trying to turn equities into income, I'm going to say, okay, well, all things equal here, I'm just going to bet on the long-term market cycle versus the idea that whatever the stock market's about to go on a roller coaster ride, and we know that's coming.
Yeah. Whatever the Fed does to affect real estate, it's going to affect the stock market a whole lot more. And bonds aren't even in the equation to help you hit your long-term goal. So so keep that in mind.
Cool. All right. We got a couple of great questions here in the chat and Q&A. Jerry, thanks for putting it in the Q&A, man. I had you in the chat though. Madison made it obvious to me, but Jerry Kreshman, which is a new name for me. I don't know. Is that a client?
Jerry's client? Yeah. Okay. Jerry's client.
All right, Jerry. Welcome to the community, man. It's the first time I see you pipe it in. I hope you stick around. Jerry writes, trying to understand the impact on JWB returns if Jacksonville follows Nashville model for downtown impact on housing affordability, and what about timing?
Great question, Jerry. Jerry, hope you come to the tour on the 25th, because you'll really get to see what we're talking about as far as Jacksonville becoming the next Nashville as far as downtown. You know, we have built our property evaluations and the investments that you all invest in. We've built those not counting on Jacksonville taking that next step as a downtown. Because if we did, we would increase the expected appreciation rate per year, right? If you look at the effect of downtown Nashville on the overall Nashville market of single family rental properties within 15 minutes of downtown Nashville, their appreciation rates have been much more than their historical average, because downtown Nashville has blossomed like it is. And here in Jacksonville, we expect the same thing. That is part of the reason why JWB is making significant investments in downtown Jacksonville, and why JWB owns over 300 rental properties right around downtown Jacksonville, just like Jerry does, just like all of our clients do. Mm-hmm. It's because that's the huge upside that is not reflected in your evaluation, right? So the effect on returns would be extremely positive. It is not quantified in your expected return on investment calculations when you purchase a property with JWB now. And it is incredibly positive for rents and home pricing if and when Jacksonville follows that same model as Nashville.
There you go. As far as timing goes, is there anything that you can say about that, man? Like, obviously, we're not promising anything here, but like in your estimation, when do you think that kind of starts to hit, if it were to hit, based on your expectations?
I think people are going to really feel different about being downtown. I think that people are going to go to downtown to have fun in Jacksonville now over the next couple of years. Like, I think in a couple of years, it is going to become an amenity in itself. People in Jacksonville are finally going to look at it as an amenity in itself. I think it's going to take a little bit longer than that for this big pop to happen from a values perspective. Call it like 2 to 5 years, which is a pretty short timeline.
It's a pretty short timeline, man.
Yeah. I mean, that's why I said, there are 5 phases to this. We're in phase 3 or 4. I think it's going to be here's why I think that. It's because there's about $4.7 billion of activity that's going on either. And this is not just projects that are waiting to be funded or waiting to be approved. There's $4.7 billion of projects that are in the ground, going vertical now, being renovated, being built in downtown Jacksonville. That's about 10x from what it was 10 years ago.
Yeah.
Right. So this is happening right now. It's a great time because you can actually see it starting to happen. You can see these buildings that are starting to be renovated and completed. And you have these other models of Nashville and Charlotte and Denver and all these other places that have already gone through this transformation.
Yeah. So if I'm hearing you correctly, it's like within the next 2 to 3 years, people are going to start seeing downtown as a cool place to be, and it's going to be a real amenity. And then you're thinking around year 5 or 6, that's when that trickle down effects really starts to supercharge what our home price appreciations in all of Jacksonville. Kind of like my buddy who just bought a house in Nashville. It was impossible to kind of find something in any kind of affordability range.
The biggest trigger will be when the numbers pencil out for developers to go into downtown Jacksonville without incentive dollars and make a significant return on their money.
Okay.
That's the trigger. And that happens quick. Once the numbers pencil out right now, you still need incentive dollars for developers to go in there.
Yep.
But it won't be that way for long. And once it starts to pencil out, you got to think Jacksonville is just like a canvas that these developers are looking at. There is so much opportunity once the numbers pencil out here versus some of these other places that are already built out, like Nashville, right? It's much more built out in Nashville. Charlotte, much more built out. So developers are looking for the next Nashville, the next Charlotte, and they're looking at Jacksonville to be that one.
GC, I think we move the third speaking point of the FHA loan limits to the property of the week. What do you think?
Love it.
Okay, cool. We'll do that as a breaking news. So that allows us to ask the question from Anonymous Attendee, who is back with us here from the south of France.
So Anonymous Attendee, you're not your average guest, though. How's that possible?
Anonymous Attendee, when you register on the regular thing, you don't have to put your name in. So you can be anonymous.
Okay.
Is this data influencing where JWB is focusing on investments? Any plan on expanding beyond Jacksonville?
Great question. This data is not influencing where JWB is focused on our investments. We are committed to we're committed to Jacksonville. Part of that is downtown Jacksonville, but we're committed to Jacksonville, and it's for a few reasons. Number one, we think this is the best risk-adjusted return on investment for our clients. There is more than enough opportunity here in Jacksonville for our clients to be able to invest and earn the best risk-adjusted return on investment. Part of the reason we feel that way is because for years and years and years and years and years now, JWB has been buying and acquiring and building out new construction inventory to make sure that our clients have a long runway of opportunity to invest in turnkey rental properties here. And there's a number of other ways to be able to invest here in Jacksonville. So no lack of opportunities for us because we have thought in advance to make sure that you all have opportunities to invest with us. And so that's a significant part of it. We also think going elsewhere, sometimes it's shiny object syndrome. You know, we've been doing that. We just celebrated our 17-year anniversary actually this past week, which is pretty cool. In that 17 years, I have sat at the forefront of understanding not just the highs of building this business, but the significant challenges when it comes to building a reputation in your community, building a contractor base, building a network of real estate professionals that come to you with real estate that we can purchase from them, with our reputation, with political and social leaders and community leaders in the community. So there is so much building our team. We have 100 people here, right? There's so much just respect that I think people need to have for going to another market. You can't just pick up what you did here and just go somewhere else and expect to have the same, success in the short run. And so I think that that's a risk for going to other markets elsewhere. And then the third one is just a personal decision. My business partners and I love Jacksonville. We're fully committed to Jacksonville. We have young families that are here, and we want to go a mile deep rather than a mile wide. And so we're just committed here.
There you go. Great answer, buddy. There you go, man. We just, you did it, GC. You completely changed directions from Thursday to today and landed it successfully. This is why we created the Not Your Average Insights, right? So that we can show up with things that matter right now, that are interesting, that are important to you as an investor. And I think that you did the right move by recognizing that our community really likes these inside nuggets on Jacksonville statistics. So great job today, buddy.
Appreciate you, man.
Yeah, man.
Thank you for all of you for giving me a platform to do this. This is what I love to do. And a lot of the times as I'm listening or looking, and reading before I had the show, it would just come to me and I would read it. And then, I would tell a few people and, and then it would just be in my head somewhere. Now I get to share it with all of you. We all get to learn together. And so I'm glad that you all are enjoying it as much as I do.
So you shared it with our 50 plus folks that took an hour of your day in the middle of a Tuesday to join us. We never take that for granted. So really, really appreciate you coming here, asking great questions, making friends with each other, joining us February 28th.
February 25th.
February 25th, Saturday, February 25th in Jacksonville. So you can all meet each other, see what we're talking about this Jacksonville magical thing that's happening and why it could be Nashville coming up here real soon. And, that your chance to really beat your expectations. And I just love doing this, man. Thanks for another great one.
Awesome, dude. Way to kick off the year.
All right, man. If you want to beat the market, if you want to preserve your capital and turn equity into income, and you want the inside scoop on Jacksonville statistics, you can't be average. Join us on Thursday.